The Schwab U.S. Dividend Equity ETF, SCHD, is undergoing significant changes in 2025, marking a major shift in its portfolio composition while maintaining its reputation as a premier dividend investment vehicle. This reconstitution demonstrates SCHD's commitment to its systematic, algorithm-driven approach to selecting high-quality dividend stocks. The ETF's methodology remains anchored in strict screening criteria. Companies must show at least 10 consecutive years of dividend growth, maintain market caps above $500 million, and demonstrate strong trading volume. The selection process evaluates stocks based on four crucial metrics: free cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. Notably, REITs are excluded from the fund. SCHD's historical performance has been remarkable. Prior to the 2023-2024 tech surge, it outperformed the S&P 500, delivering a 262% return compared to the S&P's 223% from 2013 through 2022. Over a 10-year period, the fund achieved nearly 200% total return, establishing itself as a formidable investment option. The 2025 reconstitution brings substantial changes to the portfolio composition. The fund has removed 17 stocks and added 20 new ones, significantly altering its sector allocation. Most notably, financial sector exposure has been cut from 16% to approximately 8%, with major names like BlackRock, US Bank Corp, M&T Bank, Huntington Bank, and KeyCorp being removed. This shift occurs despite the current administration's focus on financial sector deregulation. Energy stocks have emerged as the clear winners in this reconstitution. ConocoPhillips now leads as the top holding with a 4.6% weighting, while other significant additions include Merck 4.1%, Schlumberger 2.3%, Target 1.9%, and General Mills 1.3%. The sector allocation now shows energy leading at 21%, followed by consumer staples at 19%, healthcare at 16%, industrials at 13%, and financials at 8%. Some notable removals include Dick's Sporting Goods, which had demonstrated impressive performance with nearly 1,000% growth over a 5-year period. The removal of BlackRock is particularly interesting given its potential to benefit from increased M&A activity in the sector. Despite these substantial changes, the fund's dividend characteristics remain strong. The dividend yield is expected to maintain around 3.8%, and the growth rate is actually improving. The Q1 2025 dividend payout of 24.8 cents per share represents a remarkable 22.16% increase from Q1 2024, the largest Q1 dividend in SCHD's history. This significantly exceeds the fund's average yearly dividend growth of 11.57% since inception. A deeper analysis of the reconstitution reveals the fund's emphasis on dividend growth potential. The median 5-year dividend growth per share for newly added stocks stands at 33.1%, compared to just 2.46% for removed stocks. This clearly indicates a strategic focus on companies with stronger dividend growth prospects. Looking forward, the increased energy sector exposure could prove beneficial if oil prices rise to $80 per barrel, potentially generating substantial cash flow and supporting both dividend payments and capital appreciation. However, it's important to note that SCHD should be viewed as a complement to, rather than a replacement for, core holdings like the S&P 500, particularly for investors with tech-heavy portfolios. The power of SCHD's dividend growth and reinvestment strategy is demonstrated through practical examples. With the recent 22% dividend increase, an investor holding 3,475 shares would receive approximately $886 in Q1 dividends. Reinvesting these dividends at the current price of $27.84 would add 31 shares, generating about $32 in additional annual dividend income from just one quarter's reinvestment. Over a full year, reinvestment alone could add $130 in new annual income, while continued dividend growth at the historical 12% rate could contribute an additional $433, totaling nearly $563 in increased annual dividend income, without requiring new capital investment. The systematic approach of SCHD removes emotional decision making from the investment process, focusing instead on sustainable dividend growth rather than high initial yields. This methodology has proven effective over time, selecting companies with strong fundamentals and demonstrated commitment to shareholder returns. The 2025 reconstitution, while bringing significant changes, maintains this disciplined approach and positions the fund for continued success in delivering appreciation, yield, and growth to investors.